We've been talking about depreciation methods. So far we've talked about straight line, which is the most conservative method because it's the same amount each year. In other words, a straight line. We've also talked about units of production, which takes the cost minus the salvage over the life, not in years, but in terms of hours or units. Now we're going to turn aggressive, and we're going to do the most aggressive method of depreciation, which is known as the declining balance, sometimes known as double declining balance or 200% declining balance. The reason is double declining balance is computed as follows. We take the book value at the beginning of the year. Now you'll recall that book value is the cost of the asset minus its accumulated depreciation. Book value, cost of the asset, less its accumulated depreciation. And we're going to multiply it by, in this case, double, twice the straight line rate. Now you'll recall that this particular asset that we're going to use has a book value at the beginning of year one of $15,000. Why? Because it's a brand new asset. We haven't depreciated it at all. Notice we don't talk about the residual or salvage value, do we? So in year one, we take the cost of the asset times twice the straight line rate. This is the straight line rate. 100% divided by the years of life. You'll remember that that $15,000 asset was going to live 4 years. So the straight line rate would be 100% divided by 4 years, or 25% a year. That's the straight line rate, 25% a year. Double declining balance says instead of using the straight line rate, we're going to double it. So twice the straight line rate. So 2 times 25% is what? 50%. So in the first year, we're going to depreciate this $15,000 asset by twice the straight line rate, or 50%. That means the depreciation expense in the first year is going to be $750,000. I just said that wrong, $7,500. I really wanted depreciation, didn't I? So the debt entry, debit depreciation expense, credit accumulated depreciation, in year one is $7,500. Accumulated depreciation at the end of the first year is what? $7,500. That means in year two, my book value at the beginning of the year is going to be $15,000 minus the accumulated depreciation of $7,500, meaning that the book value at the beginning of year two is $7,500. Again, twice the straight line rate, or 50%, says that in the second year we're going to take depreciation of $3,750. Okay? Which means the debt entry at the end of year two is for $3,750. The balance in accumulated depreciation at the end of the second year is going to be $11,250. Thus, in the third year, when I find the book value at the beginning of the year, it's going to be $15,000, the cost less the accumulated depreciation of $11,250. So, what's my book value at the beginning of the year? Did you say $3,750? You're right. Now, here's the dilemma in double declining balance. You cannot depreciate the asset below its residual value, which means accumulated depreciation cannot go above cost minus salvage. And the cost of this asset, again, was $15,000. The salvage was what? $3,000. Which means accumulated depreciation, once it gets to $12,000, got to stop. you'll notice that we can continue to go with the 50% forever. So in the last year of life, when we get close to this $12,000, instead of using 50%, we're going to plug the answer, because the answer has to, what? Total up to $12,000. So the amount of depreciation expense we're going to take in year 3, even though this asset may live for 4, 5, 6, 7, whatever number of years, is whatever takes it to $12,000. Well, what's it going to be? $750, isn't it? So $7,500 plus $3,750 plus $750 says that at the end of year 3, the balance in accumulated depreciation is going to be what? $12,000. So this is the tricky part about double declining balance. Plug at the end to salvage.